Hi everybody, welcome to another update on the stock screener. Today we're going to talk about the NPV calculation method. And this is a new method that I just started to use a few months ago. And I think this is very useful. And I will continue to use this for all my minor investments because it takes into account a lot of things like the all-in costs, taxes, interest payments, and capex. So a lot of these costs are included in this calculation, which is much better than just calculating EBITDA, for example. And also it will visualize how the cash flows will come in or out over time. So you can actually create a timeline for yourself when to buy one stock and when to switch over to another stock. So let's try to do this for Avino Silver vs Soma Gold, just as an example. So how do we do this? So here is Avino Silver. I used NPV 10% discount rate, which is pretty high. Normally you use 8% or even 5%. But 10% is very high. So probably these numbers are a bit undervalued and could be much higher. So what do I use here? We always calculate the revenue per year and the cost per year. Revenue is derived from production and the prices of the metals. The cost is derived from the AISC and production. And then we deduct the capex, the interest payments, and we also apply a tax rate on the income. And then we get this net income at the end of all the calculations. Then we apply a net present value for that income. So this is then the net present value. And when we add this all up, we get the total amount of NPV of this project over this timeline. And this number here, these numbers here, you can actually visualize on this chart. So here we deduct 6 million, then we add 1 million minus 500,000. And you can actually see this happening here. So minus, then plus, minus, plus, plus, plus. And this is actually the previous cell plus the net income that's coming in, discounted. Okay. Same here. You take this number plus the net income here and discount it. Okay. So this is how the cash flow will evolve in function of time. As you can see, Avino Silver is probably not going to be that profitable in the coming 2 years. And why is that? Because there's a lot of capex involved. 12 million, 35 million. and that will be deducted from the income. Okay, production is still at 4 million, then 4.7, so it's not at a level that is going to be hugely profitable. Also, the costs are still at 16, 14, and only in 2026 the costs will be low enough and production will be high enough to actually increase the cash flows. So from here on out, you get an increase of 33 million, another 30 million, 50 million. But here, in the first years, you actually have not enough cash flow due to high capex and due to high costs, right? You even have losses here because of the high capex and the high costs. Okay, so that's the situation at Avino Silver. When we look at Soma Gold, we have a different picture. So here we have positive cash flows all the years because this is a low cost mine, AIC of 1000, and the only costs are the capex and some interest payments in the first few years. And you can see that the cash flows are coming in at a normal pace. Okay, so which one would we buy when we compare the two companies? It's obvious to me that I would buy Soma Gold instead of Avino Silver in this case, because this company will give steady cash flows, free cash flows after tax. This company will reinvest some of that money back into the mine, so it doesn't have free cash flows. But from 2026 onwards, it will rise pretty fast. So in this case, I would start with Soma Gold, hold it for 2 years, maybe 3 years, and then switch it to Avino Silver. Because then this one will start to rise. So that's how we play it. Now also the enterprise value of Soma Gold is at 70 million. This one is at 100 million. So visualize this as well on this chart. So here actually the market cap was 50 million plus the debt was 20 million. So we have 70 million enterprise value. That's somewhere here. So in about 2 years from now, 3 years from now, the enterprise value will be the same as the amount of cash flows that came in. So you will get your money back in 2026 because then all the debt will be repaid and you will have a lot of cash and of course further growth. So by the time that we are in 2026, the share price should be higher than what it is now, probably somewhere here, 120, 130, also depending on the gold price, of course. But there should be upside based on this chart where we are at right now, 70 million. So this should be doing something like this, maybe going up a bit. Here we will see a bigger rise. So then we go like this in 2 years, probably above 100 million. and then going higher. Now for Avino Silver, we are at 100 million. That's somewhere here. That's pretty high already compared to where we are here. So overvalued, I think. And even in 2028, we will not reach that 100 million enterprise value. Probably only in 2029, because this chart will probably go like this. Then in 2029, we will reach that value. So Soma Gold will reach it faster in 2026, while Avino Silver will reach it in 2029. But the growth is, of course, faster. So you can see that this slope is faster, steeper. Okay, so based on this comparison, I would first go into Soma Gold and then in the next 2 years evaluate again what Avino Silver is doing and then switch over to this one. So that is how we do that. Let's look a bit more at the calculations. So here is the revenue using the prices of the metals and using the production numbers here. So these are the production numbers that the company gave us right here. These are the production forecasts. I put them here. So that's how you calculate the revenue, right? It's exactly the same. The costs are calculated by the all-in sustaining costs and the production in CAD. So this is the CAD exchange rate. And the net income here is calculated by revenue minus cost times the 1 minus the tax. So there is taxes in Mexico, and then minus the interest. There's no interest at Avino Silver because they are debt-free. And then minus the capex, which is 12 million. And you can see here, capex is going to rise in 2025. As they said here, projected capex is 28 million plus normal capex, of course. So it will be around 25. And then in 2027, added 15 million project capex, which is added here. So, yep. Take into account the capex, very important, interest payments, taxes, then the all-in costs, prices of the metals. You can even play with it if you want. Let's do this. Let's say we actually go to 25 silver next year and 2100 gold, maybe 4 copper. You can see that this is rising. Silver could go to 26, 2200, 4.1. So this is actually a very interesting tool that you can use to calculate the future, right? So with these numbers here, you can easily see that the 100 million will be reached in 2028 if we use these prices. So things can change in time based on the commodity prices. Same with Soma Gold. Here we could play with the gold price only. Let's say next year we go to 2100, 2200, 2300, and it could stay here. And you can see that the slope has steepened. Currently we are at 70 million enterprise value. So we will reach the enterprise value by 2025 in 2 years, and then there's a lot of growth in the pipeline. Could go to 200 million in a few years if this growth can be sustained. I think that they will go to 85,000 production from 47,000 at some point. So this can go up really fast. So that was the video I wanted to share. Use this method for your investments because it really helps to visualize the timeline and includes all the costs, which is really important because every company is different. And this will show that. And I'll see you in the next video.